So imagine you're prepping for a major meeting,
Hmm.
right? Or maybe you're just trying to understand the shifting political landscapes.
Right, which is not easy these days.
Yeah, exactly. And you know the flaw with traditional polls. You call 1,000 people, ask them a question, and just kind of hope they tell the truth.
Right, because people might stretch the truth to sound polite or, hide their real opinions out of fear of social stigma.
Exactly. But today, for this deep dive, we're looking at a platform that attempts to bypass all of that. It's called Polymarket.
Which has become super relevant lately.
Oh, totally. We're looking specifically at its role in the upcoming May 2026 Colombian presidential elections. We want to figure out if this cryptocurrency-funded platform is like a futuristic crystal ball
Hmm.
or just a casino masquerading as a poll.
Yeah, and I mean, it is the defining question for anyone trying to stay well-informed right now. Because when you look at a prediction market, you're looking at revealed preferences rather than stated preferences.
Right.
It completely strips away the polite fiction of a phone survey, and replaces it with cold, hard financial stakes.
Okay, let's unpack this because we need to understand the underlying mechanics of how this platform actually works before we dive into this specific candidate.
Good call. Yeah, the basics are important here.
So the basic premise of Polymarket is that users invest a cryptocurrency called USDC, which is a stable coin pegged directly to the US dollar into what they call shares of a specific outcome.
Right, and in this scenario, those outcomes are political candidates winning an election.
Exactly. And the price of that share, theoretically, reflects the real mathematical probability of that candidate winning. So to put it simply, if a candidate's share cost 88 cents and it pays out exactly $1 if they win the election, the market is essentially pricing in an 88% chance of victory.
Yeah, and the mechanism driving that price is just the financial incentive to be aggressively objective.
Right, because your money is on the line.
Exactly. In a traditional poll, a voter is expressing a desire, right? But on a prediction market, a trader is executing a calculation. You aren't betting on who you want to win. You're risking your own capital on who you coldly calculate will actually take the office.
Which is a huge difference. I mean, it's like the difference between telling your friends you like a movie versus betting your life savings that it will win an Oscar.
Yeah, that's actually a great analogy.
Thanks. So that brings us to the actual numbers we're seeing for the May 2026 Colombian elections. And just to be completely clear to you listening, we're simply reporting the snapshot of data from the source material here.
Right, we're entirely neutral here.
Absolutely. We are not taking sides. We're not endorsing any candidate's platform. Strict political impartiality. We're just looking at the mathematical reality of this specific market right now.
So what are the numbers saying?
Well, looking at the Polymarket data, the left-wing candidate Iván Cepeda of the Pacto Histórico leads with a massive 88% probability to win the first round.
Wow.
Yeah. And meanwhile, the right-wing candidate, Abelardo de la Espriella, sits around 16%. Other candidates, like Paloma Valencia and Roy Barreras, are sitting at marginal percentages, well under 5%.
What's fascinating here is that if we cross-reference those market probabilities with traditional metrics of popular sentiment, the narrative completely fractures.
Wait, how so?
Well, take Google search trends in specific Colombian regions. In Norte de Santander, for instance, Abelardo de la Espriella captures a massive 73% of the search interest.
Wait, really? So he has 73% of the search interest in a major region, but only a 16% chance of winning on Polymarket.
Exactly.
I mean, one of those data sets is fundamentally disconnected from the other. They're measuring two completely different realities.
They are. And, this is the crucial conceptual shift you need to understand these platforms. Polymarket is not measuring the popular sentiment of the average voter in places like Soacha or Buenaventura.
Right, it doesn't care about search volume or rally attendance.
Exactly. It measures speculative financial conviction. It measures the temperature of individuals who have, well, the disposable cryptocurrency, the technical know-how to use a decentralized platform, and the willingness to place a financial bet.
Okay, so if this platform is strictly measuring the financial conviction of crypto traders rather than the actual voters casting the ballots, how on earth is this method supposed to be scientifically accurate?
That's the big question.
Right. I mean, I was looking at a recent study from the University of Birmingham in our sources, and they actually argue that decentralized prediction markets beat traditional centralized poll aggregators.
Yeah, the Birmingham researchers point to two distinct structural advantages. First, because Polymarket runs on a decentralized blockchain, it is highly resistant to censorship.
Oh, meaning a government or a centralized corporation can't just shut it down.
Exactly. They can't shut it down or alter the data to fit a preferred narrative. The ledger is public and immutable.
Okay, that makes sense. And the second advantage?
The reaction time is instantaneous. Like, a traditional poll requires days of calling people, weighting the demographics, compiling the data, and then publishing the results.
Right, which takes forever in a fast-moving campaign.
Yeah, whereas a prediction market digests breaking news and shifts the odds in milliseconds.
Okay, I understand the speed argument for sure, but I have to push back on the accuracy claim.
Okay, let's hear it.
If literally anyone with a crypto wallet can jump in and place a bet, doesn't that just create a chaotic, noisy mob?
Right.
It feels like the classic wisdom of the crowd experiment. You know, like trying to guess the weight of a cow at a county fair.
Right.
Sure, if you average out 1,000 independent guesses, you might get incredibly close to the real weight.
Yeah.
But on a political prediction market, people aren't making independent guesses.
No, they definitely aren't.
They're reacting to Twitter rumors, biased news, hype. Half the people might just be guessing blindly. So how does a mob of speculative gamblers equal a hyper-accurate political forecast?
So, your skepticism is incredibly well-founded, and the data actually validates that exact concern, just not in the way you might expect.
Oh, how so?
Well, there was this massive comprehensive study from the London Business School and Yale University recently. They analyzed 1.7 million accounts across these platforms.
Wow, 1.7 million. That's a huge sample size.
Yeah, and they completely shattered the wisdom of the crowd myth. The accuracy of these markets does not come from the collective intelligence of the average user at all.
Really? Then where does it come from?
The study revealed that only a staggering 3.14% of traders are consistently profitable.
Wait, just over 3%?
Yep, 3.14%.
That means like 96% of the people on this platform are consistently losing their money.
Essentially, yes. The accuracy of the market isn't a democratic average. It is an oligarchy of information.
Wow, an oligarchy of information.
Yeah, that elite 3% represents highly sophisticated actors. They're the ones building complex statistical models, running rigorous data analysis, pricing the odds correctly, and, crucially, deploying enough capital to essentially steer the entire market.
So the crowd is just noise. The 3% are the signal.
Precisely.
Well, here's where it gets really interesting. Because if the market is being steered by a tiny, hyper-informed minority deploying significant capital, what happens when overwhelming wealth enters the equation?
Yeah, that's the million-dollar question. Literally.
Right. I'm looking at a 2025 study from Vanderbilt University that analyzed 2,500 different prediction markets. And they threw some serious cold water on the idea that these platforms are infallible.
What did they find?
They found that across those 2,500 markets, Polymarket was only accurate about 67% of the time.
Which honestly is a significant failure rate for a platform that gets touted as a crystal ball.
Exactly. And the Vanderbilt researchers traced that 33% failure rate directly back to a structural vulnerability, which they call the whale problem.
Right, because Polymarket is a permissionless, decentralized protocol, so there are no investment caps.
Right. There's no regulatory body saying, like, you can only bet a maximum of $500.
Exactly. So a single whale, which is just finance terminology for a massively wealthy investor, can inject millions of dollars into a single outcome.
Okay, let's explore the game theory of that for a second. Because if a whale wants a specific candidate to look like the inevitable winner, they just buy millions of dollars of shares for that candidate, driving the price up.
Yep, and therefore driving the perceived probability through the roof.
Right. But why would they do that if they know it's a bad bet? I mean, they'd lose millions of dollars when the candidate eventually loses.
And this is the exact mechanism the Vanderbilt study highlights. Whether we are looking at historical data from Donald Trump in the U.S. elections or a candidate in the Colombian elections, a whale can artificially inflate a candidate's probability not to make a return on their investment, but to manufacture a winning narrative.
Oh, wow. I see the strategy. Because traditional media outlets and everyday voters look at the Polymarket dashboard, see an 88% chance of winning, and just assume that candidate has massive, unstoppable momentum.
Exactly. They screenshot that 88% and blast it across social media.
So the whale willingly absorbs a multi-million-dollar financial loss on the prediction market because they view it as a highly efficient marketing expense.
You nailed it. If you're a billionaire trying to sway a national election, spending $5 million to artificially inflate a prediction market might generate way more media coverage and psychological momentum than spending $5 million on traditional television commercials.
That is wild. It creates a self-fulfilling prophecy, totally detached from the actual political reality on the ground,
Completely detached.
which fundamentally compromises the platform as a pure forecasting tool, doesn't it? I mean, if I'm listening to this right now, trying to figure out how to filter my daily news feed, and I know that the data can be brute forced by one billionaire with a crypto wallet, why should I pay any attention to these markets at all?
Well, mostly because of the predictive speed, provided you understand the mathematical context of when to trust it.
Okay, fair.
There is this fascinating study from 2025 published in the MDPI Future Internet Journal. They utilize an advanced algorithmic analysis technique called dynamic time warping to compare prediction markets against traditional polls.
Yeah, I read through that methodology, and dynamic time warping is a brilliant concept.
It really is.
From my understanding, instead of just comparing two graphs linearly by date, the algorithm essentially stretches and compresses the time axis.
Right.
It looks for matching patterns, like a sudden spike or a sharp drop, regardless of exactly when they happened, just to figure out which data set is leading the other.
That is a perfect summary of the mechanism. By warping the time axis to align the patterns, the researchers discovered that Polymarket doesn't just react faster, it actually front-runs traditional polling data by up to 14 days.
Up to 14 days. 2 weeks is an absolute eternity in a political cycle.
It really is.
It means if a candidate has a disastrous debate performance or, a major scandal breaks on a Friday night, the market digests that information and maps the shift in momentum 2 full weeks before the traditional pollsters can even formulate their questions, call 1,000 households, and publish a survey.
Exactly. But, and this is a massive but, the MDPI study emphasizes a huge caveat here.
What is it?
This predictive speed and accuracy only materialize in high-volume, high-liquidity markets.
Oh, I see.
Yeah, market needs tens of millions of dollars actively trading hands every single day to absorb and neutralize the impact of a whale.
Right, because if there's enough liquidity, one billionaire trying to buy a narrative will just get crushed by the sheer volume of those elite 3% traders who recognize the price is artificial and bet heavily against it.
Exactly.
And this is where the Colombian market becomes really vulnerable, right? A specific national election on a global platform might not always attract that massive insulating wall of liquidity.
Yeah, that's a very real concern.
If the daily trading volume is low, a single whale can dictate the price without facing any serious financial resistance. The study makes it clear, in low-volume environments, the data isn't a signal, it's just noise.
It is entirely noise. And it forces us to look at the grim reality of what this platform actually represents for the vast majority of its participants.
Yeah, let's talk about that.
An Orxiv study from 2025 took a deep dive into the specific trading strategies being deployed on Polymarket. They analyzed a tactic known as semantic arbitrage.
Semantic arbitrage. Let's break that down because it sounds incredibly academic, but the actual practice is kind of devious.
It really is.
It essentially means traders are finding loopholes in the specific wording of the betting criteria, right?
Yeah, precisely.
Like placing a bet on whether a candidate wins the most votes versus whether that candidate is inaugurated as president. Because in a highly contested election with legal challenges, those are technically two completely different outcomes.
That is the exact mechanism. The sophisticated traders aren't just predicting politics, they're parsing the legal definitions of the smart contracts that govern the payouts.
Wow.
But, the most sobering revelation from that ARC-6 study wasn't the advanced strategies, it was the classification of the user base. They categorized a full 67% of the accounts on Polymarket as unskilled losers.
Ouch. That is a brutal phrase to see in an academic paper. Unskilled losers.
It's harsh, but it highlights the casino effect of the platform. 2/3 of the users are drawn in by the gamification of politics.
Right, they're treating it like a game.
Exactly. They're trading on emotion, bias, and media hype. They're essentially just bleeding their capital, and their consistent losses are the exact revenue stream that funds the profits of that elite 3.14% of traders we discussed earlier.
And for the majority, it isn't a forecasting tool at all. It is a casino where the house edge is controlled by a tiny fraction of data scientists.
Sadly, yes.
So what does this all mean? I mean, we've navigated from the theoretical purity of betting with your wallet to the reality of billionaires buying narratives to the hard data showing that most people on the platform are just serving as liquidity for experts.
It's a lot to take in.
It is. So for the listener who just wants to be well-informed, how should they actually process a Polymarket screenshot when it inevitably pops up on their social media timeline?
Well, the core takeaway is that you need a fundamental shift in perspective. You should really view Polymarket as a financial tension thermometer.
A financial tension thermometer. I like that.
Yeah, it's an incredibly brilliant tool for taking the temperature of speculative global capital in real time. It tells you exactly how financial markets are reacting to breaking news.
Hmm.
But you cannot view it as a crystal ball for society's voting intentions.
Right. An 88% probability on Polymarket does not represent the political will of the teacher in Bogota or the farmer in the coffee axis.
Exactly. It represents the financial calculation of the people holding the capital.
I really love that framing. A financial tension thermometer. It tells you how hot the money is running, not necessarily how the ballots are going to be cast.
Yep. And looking ahead at the May 2026 elections, our sources outline three massive systemic challenges that this technology is going to force society to confront.
Okay, let's hear them.
The first is regulation. The National Electoral Council in Colombia, CNE, is already raising serious red flags about how these platforms operate.
Oh, because of the electoral silence periods, right?
Exactly.
In many democratic systems, there's a legally mandated blackout period right before an election where you cannot publish new polling data. The idea is to give voters a few days to make up their own minds without being swayed by the bandwagon effect of a last-minute poll.
Right, but how on earth does a National Electoral Council enforce a blackout period on a decentralized global blockchain?
I mean, they fundamentally can't. You can't send a cease and desist letter to a decentralized protocol.
No, you can't. So the regulatory headache becomes, do you try to ban the media from reporting on the Polymarket odds?
But if you do that, you risk creating a Streisand effect, where the forbidden data becomes even more viral on social media.
Exactly. The CNE is grappling with whether to treat this as an illegal, unregulated poll, or if it is protected under the umbrella of international financial freedom of expression.
Man, that is an impossible legal line to walk.
It really is, and that directly feeds into the second challenge, which is education and media literacy.
Yeah, that makes sense.
It is incredibly difficult to train the voting public to understand the nuances of probability versus vote share. When a news graphic flashes on the screen showing a candidate at 41%, the ingrained habit of the average viewer is to assume that means 41% of the country supports them.
Because they view it through the traditional lens of a poll.
Right. But as we've established, that 41% just means someone executed a smart contract at 41 cents 5 minutes ago.
Yeah. Breaking that mental habit and teaching millions of voters to parse the difference between market probability and popular support is a huge generational media literacy challenge.
Huge. And the third challenge outlined in the research is perhaps the most disruptive of all, the rise of AI semantic trading.
Oh, wow. AI trading bots.
Yeah. We're moving past the era where human psychology drives these markets. Developers are already deploying highly advanced AI bots that are programmed to ingest global news feeds, instantly analyze the sentiment of thousands of articles across multiple languages, and automatically execute trades on Polymarket in a fraction of a second.
So the market isn't even reacting to human traders synthesizing the news anymore. It's reacting to an algorithm's interpretation of a news cycle.
Exactly.
Which honestly brings this entire discussion full circle. We started this deep dive talking about the inherent flaws of calling 1,000 humans to ask them how they'll vote. We wanted a better shortcut, right?
Yeah.
A purer, more objective truth devoid of human bias. But if we reach a point where AI bots are autonomously reading the news to place automatic financial bets, and human voters are looking at those resulting algorithmic market probabilities on their phones to decide who has the momentum to win, are humans still driving the democratic process? Or are we just following the financial speculation of an algorithm?
That is the million-dollar question.
Definitely something to mull over the next time you see a sure thing prediction on your timeline. Thanks for joining us on this deep dive. We'll see you next time.